So welcome, I'm Lori Greymont with SJREI. We always say where deals happen, and you can ask me anything about real estate. Tonight, I want to talk to you about a 1031 alternative. Right now, 1031s are kind of in the shotgun approach of the government trying to attack the wealth of the middle class and upper class. And so we want to share with you a way that you can defer your taxes for at least 30 years by get cash now. So we're going to get started here. Of course, seek out your own professional legal and investment advice always. What I share is just my experience. I am not an attorney or an accountant. I am an investor. So we hear this a lot of times. It's not as much about what you make that matters. It's what you keep that matters. You know, they say that building wealth is hard, but keeping wealth is even harder. And so that's a little bit about what we're talking about tonight. I'm going to start very basic and high level here. So in a traditional sale, the seller receives the buyer's money in exchange for an asset. The buyer receives money and gives the asset to the seller. But did you know that it's not actually selling the asset that is the taxable event? It's not the sale that triggers the tax. It's actually an event called constructive receipt. Constructive receipt is the name that the IRS gives to you receiving sales proceeds. As soon as you receive your sales proceeds, it is a taxable event. And the taxes are due now. So working with many of the clients that I work with, it's not uncommon that they end up paying almost 30 to 40% of their gain in taxes, because it's not just the gain on the asset. They also have depreciation recapture, and sometimes there is proceeds over basis. And so it ends up being quite a bit. Now, if you were to pay the $300,000 in taxes, that's money that is gone. Like, you don't get to use that money anymore. But just imagine if you were to take that $300,000, invest it at 8%, which is pretty easy, compounded for 30 years, which is what we're saying we can defer your taxes for. That $300,000 that you would have paid to the government can easily turn into $3 million, at which point you can pay a tax bill of $300,000. Now, let's talk a little bit about 1031s. In a 1031 sale, the seller sells directly to the buyer. But the reason the 1031s can defer taxes is the constructive receipt. They do not receive the proceeds. So the seller releases the asset to the buyer receives the asset, but the money, the proceeds, go to an accommodator. Qualified intermediary is another name. You'll hear QI, accommodator, they're all the same. They are somebody who is set up to hold the seller's proceeds. So there is no constructive receipt in a 1031, but to be completely tax-free, there's also no cash. You have to identify within 45 days what you want to purchase and then make a purchase. You have what something is called carryover basis. So whatever your basis in your old asset is, it comes over. So it reduces the depreciation amount that you can have on the new asset. And typically you have to have increased leverage. It is a good alternative for a lot of people, especially if you have very little difference between what you paid for it and what you're selling. But if you have a lot of equity in the property, it is not a good alternative. So the program that I'm going to share with you, first of all, I want to let you know that the program that I'm sharing with you has all parts. So as I explain this, you don't have to go and figure out how to make one of the pieces work. I'm going to take care of all that for you. It's a program that you basically raise your hand and we do it for you. But I want to explain the background of it. The IRS has a code that has been out there since 1913. It's M453. And essentially it says if you make a sale on an installment sale and you don't receive back all of your principal, you only have to pay taxes in a pro rata share of the principal received. So a lot of times as investors, we know about this. We say, hey, how about I buy your property interest only? Because if it's interest only, you don't have to pay capital gains on it. That's where this is coming from, M453. So in this process, there's going to be two steps. The first step is how we defer your taxes. The second step is how we put cash in your hands so that you can use that cash for the next 30 years. Okay, so I'm going to explain the first step first. The seller has an asset. They sell it on an installment sale to our capital asset dealer. The capital asset dealer writes a contract, installment contract, that is interest only to the seller. So now the capital asset dealer has bought the property from the seller, and the seller has deferred their capital gains tax for 30 years because they have a contract for 30 years interest only. The capital asset dealer immediately transfers that to the buyer. The buyer is completely unaware that this is going on in the background. And the capital asset dealer receives the buyer's funds. So the seller didn't receive them. There is no constructive receipt. The capital asset dealer now has money in their pocket, and the seller is sitting there with a contract for monthly payments. It's good in that we have no constructive receipt. We've deferred the taxes. But then the question comes in, how do I get the cash, right? What about the lump sum? Where's the money? So again, this is the first step where we defer the taxes. The buyer has the property. Now we're going to talk about how you as the seller would get a lump sum. We bring in a private lender. This private lender gives you an unsecured, no recourse loan in the amount of 93.5% of your sales proceeds. In exchange, they take that installment sales contract. They want those monthly payments, and so they will take those monthly payments, and you walk away with a business loan. This business loan, the funds are yours to use. You never have to divest them and pay them back. They do need to be used for business purposes in order to get the interest write-off, right? So you have interest income coming to you on the installment sale, and then you have interest expense on the business loan. They equal each other as long as you use that loan for business. So in this, essentially the buyer's money goes to the capital asset dealer, and you receive a business loan. They're essentially the same amount, but they are written from two separate parties, which makes this legitimate process. And again, the capital asset dealer makes all those monthly payments, so you never have to make a payment on your loan. And at the end, the capital asset dealer pays off the loan with the money that they received from the buyer. We handle this through an automatic escrow. This escrow is set up. There is an annual fee that you pay. It's like $300, but essentially everything flows automatically. You have no management to do in this process. There's 3 escrows that are set up to keep this step by step so that it excuse me, so it can stand up in court. If you start on the right-hand side where it says the dealer, that is where the dealer puts in the payment that is on the installment contract. The instructions in this escrow account automatically tell it to flow it to the seller's account. This is an account that is owned by you, but you never touch it because those instructions say to automatically make a payment on the loan. And so essentially you are getting the money to make the payment on the loan. In 1980, Congress said that a seller could receive loan proceeds in connection with an installment contract and still receive the tax deferral. So what was happening was that basically farmers were selling their lands on the contract and then going and getting a loan, and they needed that loan to survive, and the government said, yes, that's fine. So you can receive tax-free loan proceeds almost equal to your selling price. So you might ask again, how does that loan get paid back if you as the seller aren't paying it? So if you remember, the buyer's money goes to the capital asset dealer. So they just receive money that isn't theirs. The capital asset dealer invests that money in predetermined investments that the private lender has designated. The capital asset dealer has a track record of receiving 9 to 15% annualized on those funds. They use those gains to make the monthly payments to the private lender on the installment contract they wrote with you. The installment contract is at 6%, so the capital asset dealer is doing well with the spread. So you might ask, why would the IRS allow this? Honestly, not only do they allow it, but they actually issued a memorandum in support of it. The IRS wants us to create debt because creating debt creates more taxable income. And so this is one of the ways that they do it, is they encourage activities like us buying buildings, us financing buildings, selling buildings, all of that kind of stuff so that they can tax more. And this is one of the options that they're allowing. So you might say, well, what happens if the dealer puts all the money in the stock market and loses it? Or what if the dealer doesn't make the payments? In the beginning, I had mentioned that this was an unsecured, no recourse loan. The reason the private lender is willing to make this is because they know who the dealer, or I'm sorry, they know who the asset dealer is, and they need us to make this work. So if you think of it, the private lender is really a manager of pension funds, and they want a steady 6% return on their money. So they have worked it out with this asset dealer to invest the money that they get from the buyer in particular funds that allows and creates that safety of that 6% investment. So why would they make it? They're in pursuit of consistent long-term risk-adjusted returns. And so they have worked out this plan, and we are the benefactors of it. What does nearly equal mean? So you will receive 93.5% of your net proceeds. So if you had net proceeds on your HUD of $1 million, and this is before you pay off the debt. So if you had $1 million, you would get a loan of 95%. And then there's origination fees and escrow fees. So you would end up with $935,000 in cash today that you can use for 30 years. And then in 30 years, your taxes would be due. Who is the lender? It's a non-institutional private lender from a long-term mortgage broker. So think of somebody like Bank of America or Wells Fargo. They set up their own individual private lender to do this. So what happens if the seller dies before the 30 years are up? Just like any of the seller's other assets, the installment loan and the installment sale and the loan will be part of the seller's estate. Those that settle the estate can choose to pay off both of them, or they can leave it out there and defer the taxes still until that original term is up. So there's no additional management. Remember, there's the automatic escrows, and really nothing is due until that time comes. Now, at the time that the 30 years are up, what's in the estate to pay the taxes, that is completely up to the heirs. And I know that a lot of people have decided to use this as a management tool. And so I would refer you to some long-term planning for that. So what happens in 30 years? First of all, I will tell you that the asset dealer oftentimes recommends an extension for another 30 years. So it doesn't necessarily happen automatically, but typically the way it's laid out without the extension is that on that 360th payment, the dealer would take the money received from the buyer and pass it through to the seller. At that point, the seller now has constructive receipt, and that means that taxes would be due on the gain, whatever the tax year rates are for that year. So let's say that this particular transaction, you had a gain of $1 million. And in the year, 30 years from now, that gain, you had to pay 100% tax on it. Hopefully between now and 30 years, you've grown that $1 million. And if you've grown it well at 8% compounded, it's now worth 10 million, and you have to pay 100% tax of $1 million, you're still doing really well. So a lot of people get concerned that they don't get to tie in whatever the tax rate is for what it's going to be in the future, but this is your chance to get ahead of that. So high level, what we're doing is we're swapping taxable sales proceeds for non-taxable loan proceeds. Just swapping them. I have a couple questions here that typically people ask. Couple points here. When do you start this process? So first of all, I tell people that we need to be involved before any funds would go to a 1031 accommodator. If you have already closed on a 1031, most likely we can't help you. We do have a couple 1031 accommodators that will work with this program. If that's the case, the wording in the contract had to have said that you would allow 1031 or MIS. Oftentimes that doesn't happen. So it's really important to plan ahead of time before you get into receiving those funds or those funds get sent to accommodators. Now, I will tell you a lot of the larger 1031 accommodators, they don't want to do this because they recognize that this could be the death of their industry. And I will tell you that I have sent all of this over to John Heyer. He actually did an extensive webinar after he dug into it. He was giddy about this program. He said, absolutely, he is willing to write an opinion letter. The benefit of having an opinion letter is that it saves you on the penalties should something come back on the IRS and they say that they don't allow it. But his point is that he would love to take this to tax court because he knows he will win. He's like, give it to me. Because of the way this is structured with different entities, and we are just using the two pieces that are allowable, he is very confident, like 99% confident that this would stand up in any tax court. So if you know who John Heyer is, you know that's pretty strong words. So one of the questions people ask me, I had mentioned earlier in 1031s, why is the carryover basis a bad thing? one of the benefits of having large assets is the depreciation, because depreciation offsets the income. The larger the depreciation, the more income that is set off. But if you have to take a basis that is low, so let's say you bought a $150,000 asset and now your basis is $30,000, the 150 you have to replace with the new asset, but you only get to depreciate the 30. So you lose some of the depreciation. Whereas if you were to do this, where you got all your money out and then bought it, that new asset would depreciate at the purchase price. You wouldn't have the carryover basis. So again, it's not what you make, it's what you keep that matters. Any questions?
Lori, Zach has a question here. Can this note be held by a trust?
As far as I know, it's whoever is selling the asset gets the note. The entity that's selling gets the note. So if you're selling out of an LLC, then that's who gets the note. If you're selling out of a trust, then that's who gets the note. Or if you're selling personal, that's who gets the note. Mm-hmm.
But can the note be transferred, I guess is the question, to a trust? If the LLC is the receiver of the note, can the LLC sell that note receivable to the trust?
All right, so let me go back to my slides here. Which note are you referring to?
The note, the 93.7% note for the cash
loan.
Yeah.
The loan note. Yeah, no. So basically, most of what's being done is paperwork in order to get you funds. So this 93.5% loan that you're getting, so you're going to get, let's just say $935,000. That loan stays out there. There is an interest expense. Every year you'll get a statement of the interest expense. The installment sale, every year you'll get a statement of the installment sale income. Those two offset each other. So they need to be in the same entity to offset the tax advantage. What you go do with this $935,000 is completely separate from all of this. This is just paperwork that sits here for 30 years. You can go take this and put it in Bitcoin, or, buy a business boat, that you're going to use, or, whatever you can call business, you can do with that money. And that's completely separate from the loan and the installment sale. Other questions? Does it make sense what I went through?
Lori, are there any rules specific to investors in California that we might bring up?
Yeah. So this works very well everywhere. Of course, California has all its little own nuances. So in California, anything that you sell must be in an entity like an LLC or a corporation. It cannot be in your name personal. Also, the other thing that does not work on in California are personal residences. Now, large personal residences outside of California, there are some that they have allowed. We helped somebody with a $10 million personal residence do this. But most of what we work on are businesses. Like we helped the company Shazam. They sold to Apple, and the founder's stock, we were able to help them defer the taxes on this by using this method. Apartment buildings, very common that we work with companies that are selling apartment buildings. A lot of times an apartment building, it's owned in one company that might have limited partners in another. So we take it through this, and they can give the money to different people, and then the GPs can go into their own investment and not take along everybody with them.
Are there any entry level, like value levels that the
Yep,
broker
thank you.
requires? Okay.
Yeah, so your net proceeds, so before you pay off debt, your net proceeds need to be over 500,000. Now, I've said it a couple times before you pay off debt. So if you're going to use this, you will pay off the debt still, but your loan will be big enough to pay the debt off. So basically you're refinancing that debt into this loan, and that's what makes that not receive boot. Because if you were to 1031 and not replace the debt, it's considered boot. And so we're replacing the debt with this debt.
So
Okay.
Lori, in contrast to 1031 exchange, right? I always have this email that I send. Okay. And
Yeah.
so what I always say is, so get 93.5% non-taxable event cash at settlement. So in contrast to the 1031, so there's no 45-day designation limit. There's no 100-day settlement limit. There's no like kind requirement. There's no limitations on nature or scope of reinvestment. And it's a complete tax deferral strategy. It's a 30-year tax deferral strategy. And you earn money on the otherwise taxable tax money for 30 years. That's usually my bullets. That's about it as a summary.
You wrapped that up beautiful. Yes. So essentially you defer the taxes by using the installment sale. You get an unsecured non-recourse loan. Loans are not taxable. You get that for 93.5%. Whatever you invest that in can stay there forever. It never has to be sold to pay that loan back. Because if you remember, the buyer's money is sitting with the capital asset dealer. So in 30 years, that capital asset dealer will pay off the loan. Your money is completely separate from that. And you know, it's just an amazing way to move your wealth forward without being trapped in the 1031 cycle. So. Well, if there's no more questions, we're going to respect your time and call it an evening.
Thank you, Lori.
Thank you, everybody, and we'll talk to you soon.
Bye-bye.